the 12-month range, and the loss provisions might not be as big. It was a big conceptual discussion.
So the way I understand it is that if there is any indicator.
No, but the U.S. FASB said a loss could be incurred, but you don't know about. I've given you all loans, you all made payments on time, but someone has borrowed money from their brother to keep making the payments, but we don't know about it. So the U.S. approach was to say, we want you to estimate a component of the loss for loans that are on time, but the loss is there because you don't know yet. So the U.S. was more aggressive. It was very subjective. No, but they were arguing, conceptually they were saying, there's a loss, you don't know about this happened. Look, when does a loss happen? You don't really know. That's the reality.
Identification period, no? Then how much is the loss identification period? In this case, it might be maximum 3 months or say 6 months.
No, but they would book it, if you have a 10-year loan.
Yeah, the loss identification period can't be more than 6 months.
Well, they were very aggressive on these models. So my point is, the U.S. regulator was more demanding to make loss provisions before there was an indicator. Globally, we made the loss provisions when we had the indicator. So the way the U.S. applied the model, they forced banks to say, book more losses based on some sort of guess. Because when is a loss incurred? You have no idea. You really don't know. You're guessing. It's a total guess.
But no, I think it's a similar situation as we have just learned while doing IFRS 15, where the sales return, intermediary sales, we were accounting for those expected returns. So what is the basis of calculating expected returns? Is the history, like historically, if in the past 3 years,
correct,
5% is the returns, so for any future sales, I'll have to account for the 5%.
But the point I'm trying to make is, but when is a loss incurred versus inspected? Expected is easier. Incurred is a bit more. When is it incurred? The point is, it's incurred. You don't know when it's incurred.
No, it's probable and major reliability.
Yeah, but hold on. My point is, when a loss is incurred, is when a customer cannot pay back the amount of money. It's incurred when a customer loses their job or something's gone wrong. We don't know the point of it's incurred. We're only aware of it when they make the first late payment. So the point I'm trying to make, the U.S. regulators were saying, we believe there are more incurred losses in your portfolio that are perfectly on time in the current category because they're moving money around, but there's a loss there. And the point I'm trying to make is in the U.S., it took a more aggressive approach to book incurred losses from the current category, where globally, there was not as aggressive of an approach. So, go ahead.
In ECL model, we are providing loan or estimating losses for
12 months.
Loans as well.
For 12 months only, though.
Yeah.
But for stage one, the majority of your loans are stage one.
Okay.
So the majority of your losses are going to be just a 12-month loss.
Oh. So you are saying we are not calculating for the lifetime losses for the 12 months or for good
Well,
loans?
it's the lifetime losses of what goes into default in 12 months.
Yeah.
So stage one means we expect, I'll get to this a little bit later, stage one means it's going to go into default in 12 months, then you book the lifetime losses. So if it has problems, but it goes into default in 24 months, you don't have, it's stage one. So the point is the American regulators, look, it's a complicated discussion. The point I'm trying to make is the Americans were concerned that the ISB model about when it goes into default becomes when it's going to be stage one or stage two, not when it's incurred. Because the Americans were saying default is before, the Americans were saying the incurred loss is before a point of default. That was a perspective. So anyways, my point here is, that's why the Americans came up with a different approach. The Americans feel, I'm not sure if it's correct, because we also have our fair share of financial scams, but the American FASB or the American regulators feel that the regulators can protect investors and the expected loss, they can stop manipulation. I don't think that is correct. The ISB perspective is well, we can't stop all the manipulation, so we come up with this 12-month thing. So when I ask which one is better, they both give me headaches. But I would say the IFRS model is more academic. So what I wanted to do is start with the ECL model first, and then we'll go on to the other topics, because I think the ECL model is more demanding. So, do you want to have lunch first, or we go for another 15 minutes? You fresh or you dead? You're fresh? Because we're supposed to start at 9 today. You came late. You slept in, huh? Your alarm clocks, you bought them from China, right? They were broken. Okay, I'll come back to all this, because there's a lot of interesting stuff here. But I wanted to talk about the ECL. Okay? So if you flip forward a few points, okay. So again, we had the crisis in 2008, and there was a committee put together by the ISB and the US GAAP people to say, was the crisis the fault of the standards? And of course they said no. But they said the problem with accounting is we book losses too late. So they were tasked initially to come to a single solution to deal with losses based on expectation. But they couldn't agree on anything. So, this is from 2008. The US GAAP approach is to book all lifetime losses, which means there's a massive risk of manipulation. Now, conceptually, that's superior, right? Because IFRS is saying, book some of the losses. Imagine you go to a normal investor. So you want to explain to an investor. So, dear investor, what we did is we booked the losses of what goes bad next year, but if a loss goes bad in year 2, we skipped it. What's the guy going to say? You're cuckoo, right? I mean, what would they say? You're nuts. They say, what? Say that again. I mean, to us accountants, the first time I saw this model, I read it like 3 times. I go, what? 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 Remember when the first time you saw it? Doesn't it seem Chinese? Doesn't it seem strange?
Why only 12 months?
Why 12 months? Oh, that's a rule. Hold on. But IFRS is principle-based. Not anymore. We're going to swap with the Americans. We'll take the rules and they can have the principles. So, basically, but there's reason for that. Because they're concerned about the manipulation. So, both models are problems. And what's clear to me is they have to converge eventually. 2030, 2025, well, the standard just came out, right? And it took 10 years, it took more than 10 years, right? They started the standard in, was it 09, 08? 9? But the first discussion paper was earlier, before 08, I believe.
2009 was the starting point.
Of the ED.
Yeah.
But before the ED, there was a draft.
That must have been in 2008.
Yeah, I don't remember. But it took a decade.
The result of the crisis.
But I think they were anyways looking forward. There was a discussion. I think before it, there was even discussions.
There was a Norway agreement way back in 2002, but there
Yeah.
was no real, the
But it became big.
borrowing costs and the other smallest countries.
But it became big after 08. But I think it was even discussed before. Should we change it? But it became as a primary project. It took 10 years, and it couldn't even agree with the Americans.
It was a reaction to subprime loan crisis.
Yeah.
And whenever you react, you cannot be principle-based, usually.
But the Americans went principles.
A cause.
The Americans went principles.
I don't know Americans or others, but for this particular history, it was a reaction.
It was a big reaction. Yeah, big reaction. Big reaction.
And even the results of this reports of, against subprime loan were presented in the Senate after 2008, quite late. Right? So in parallel, the regulator was working on finding the alternatives, how to engage the minds of
Correct.
people, and on the other hand, there was investigations and other things going on.
Exactly.
So it all created a chaos, right? And out of this chaos, we are getting this legislation, which obviously the common sense is very difficult for this to pass.
But it's irrespective of that, I still think it's a very difficult standard to write. If you're worried about manipulation, you're worried about expected losses, you're caught between two different things. Because if you go to pure expectations, there's going to be manipulations, right? And if you go to pure incurred loss, there's going to be an understatement. So this started in 08 and it moved on. So basically we moved from an IS-39, an incurred loss model, which makes sense for IS-36. Because IS-36, we don't expect losses. But it doesn't make sense for a financial instrument. And IFRS 9 moved on to an expected losses, which is not based on objective evidence of impairment. So, sorry, they copied the wrong box there. Okay. So if we just go through some of the concepts. If we talk about equity instruments and they're fair valued to OCI, do we care about impairment? If an equity instrument is fair valued to OCI, impairment is important under IS-39. Why? Because in IS-39, we have a concept of recycling. Okay, so what is recycling? Where you take the bottle and you put it back. What's recycling? Correct. Unrealized OCI, realized P&L. So in IS-39, the issue was impairment is deemed realized. And if it's realized, it gets recycled. Then we had this concept called OTTI, other than temporary impairment, right? And we had to determine if the stock price went down, was that a temporary impairment or a permanent impairment? And we had to look at these factors, right? Significant or prolonged. And then the Big Four said, well, significant is over 20%, 30%, the Big Four said, and prolonged is over a year. The standards doesn't say a year or 30%, the Big Four do, right? And then it becomes this arbitrary thing. It's like, well, is that significant? Well, it's 28%. Well, you know, it's arbitrary. The difference is in IFRS 9, there is no more recycling for equity. We recycle debt. And because there is no recycling, it doesn't matter if the loss is incurred or not incurred, because if it's at fair value to OCI, there's no adjustment necessary. It doesn't matter. So in some ways, IFRS 9 is easier if you have shares classified as fair value to OCI. That's an optional classification in IFRS 9. I'll do the classification next. I want to do impairment first. Normally I do the order differently, but I want to cover this.
Kept it for debt, the recycling.
There still is for debt, yes.
Why they kept it?
Because they want the amount in the P&L to be the same, irrespective of that amortized cost or not amortized cost. That's why. That's why. So, financial assets at amortized cost, this is the same as IS-39. When you have an impairment, you use the original interest rate. You don't change it. You don't go back and recalculate the interest rate. You do the EIR calculation. There's a revised set of cash flows. You use that original interest rate. Debt instruments are different because debt is recycled. Now, why is debt recycled? Because the argument is if you use amortized cost or fair value, the P&L is identical. What's different is OCI. What's different is OCI. So if you book a gain and it goes to OCI and the gain is realized, if it was amortized cost, it would hit the P&L. So why is it different? I guess because conceptually, debt instruments have an income stream to them, and conceptually it makes more sense to have the income stream be unchanged irrespective of the method of treatment, if it's fair value to OCI or if it's amortized cost. Where shares are a bit different, they have a longer term in nature, the selling point is more difficult, they said no. The interesting, in IFRS, the trend is no recycling, single recognition, recognized once. In US GAAP, the trend is always to recycle. So we have a different mentality. So IFRS, no recycling, US GAAP recycle. Of course, we don't do that always. IS 21 translation adjustments are recycling.